In this presentation, we'll take a look at itemized deductions related to state and local taxes. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Remember that as we talk about itemized deductions, we will only be taking the itemized deductions if they add up to a sum greater than the standard deductions. The standard deductions, depending on the marital statuses, we'll see down here, including single of $12,000, married filing joint of $24,000. There will typically be 4 categories of the state and local tax deductions on the Schedule A, including personal property taxes, local real estate taxes, other state and local taxes, and foreign taxes. Of those, the most common or the largest amounts that will be most beneficial to many taxpayers will be the state and local taxes and the property taxes, typically on individuals' homes. So the state and local tax will typically be the amount we pay if we're in a state that has taxation. So if we're in a state that has income tax for the state, when we file our taxes, then we have a federal tax return and a state tax return, and we'll typically be able to deduct the amount of payments to the state for federal taxes if we're itemizing as a state and local tax. If we're in an area that does not have a state income tax, then they probably have sales tax, and so we'll be able to deduct the sales tax. That's typically how that will work out. The property taxes for many individuals is going to be the home having property taxes, which could be a significant amount of tax. This is a significant amount that could help to push people over to the point greater than the standard deduction, and therefore a point where someone would need to itemize. So, in other words, if someone has a home, then you're much more likely to be into a case where you're itemizing because you may be able to deduct both the interest and the property taxes to large amounts that could push over that threshold. Remember, however, that the threshold is larger this year on the standard deductions than the prior year. So even with those items, it may not be the case that people will be itemizing even if a home is owned. There is a limitation on state and local taxes starting in 2018. This is a change from prior years of $10,000 for the itemized deduction. So even if we're itemizing, we only get the cap of the $10,000, which won't affect most people, but it could affect high-income individuals, people that own expensive property, and it's likely to affect people that live in areas which have much higher cost of living. So if we're living in an area that has a high cost of living, then obviously the house is probably going to cost more, and the property taxes on it are probably going to cost more, as well as the state and local taxes may be higher, and that cap in those areas and for more well-off individuals could affect taxpayers. Like most deductions, the state and local tax is on more of a cash basis. So we get the deduction when we pay the tax. And if you think about it, that causes a bit of a problem, because if we're thinking about the income tax for the state, for example, how much do we pay the state for income taxes? What if we overpay the state? What if we overpaid the amount to the state now, and they're going to give us then a refund? Well, typically what happens is we would deduct the overpayment in the current year. We would deduct what we paid to the state in the current year. However, in the following year then, we will get a refund from the state. And because we were able to deduct it in the prior year, the refund that we get in the following year, we're going to have to record as income and then record the taxes or pay taxes on the income. So in other words, we basically get the deduction for the excess of the payments that we made in the current year, but it evens out over the 2-year period in a way in that we then have to add the income to the following year. This gets a bit complicated, however, because if we do not get the full deduction related to the income taxes, then we should only basically, the general rule is that we only have to record the income in the following year for the state refund if we got a benefit for it in the prior year through a deduction. So in other words, if we didn't itemize in the prior year, then we're not getting a benefit. And you can think of some other situations, we won't go through all of them now, but you can think of some other situations like, what if we just barely got into the itemized deductions, then I didn't get full benefit probably from all the state taxes we paid. So then we'd have to think about, should we prorate how much we'd have to include in income as a receipt in the following year. So we can think of situations like that. But the general rule, if we're itemizing, then we got to write off the state taxes that we paid in the current year, and therefore in the following year we have to record the income for any refund as income to pay taxes on it in the following year. On the state tax side, remember that if we're in a state that has state income taxes, then typically those will be higher than the sales tax. So therefore, we're probably going to take the state income tax. We can usually deduct one or the other. Some states don't have an income tax, and therefore they probably have a higher sales tax, possibly, because that's how they've decided to tax. And therefore, in those states, it would be beneficial to deduct in some format the sales tax. And note, this was a debate a few years ago, and it's probably one of the main reasons for the change to the taxes at this time as well, because the attempt is to take the taxes out completely. I think that would be the aim or the objective, because clearly the taxes have an incentive, or they affect how the states govern in terms of how they do their tax system, and that's what shouldn't happen. The federal government should not be influencing how the states decide to tax themselves. The states should be sovereign to tax themselves in any way they choose. And so that's kind of the debate that may have led to some of the changes, both in terms of allowing sales tax as a benefit to those states that don't have income tax, and as the current debate as to whether state taxes should be included or what the cap should be on state taxes. Then we have the foreign taxes. Foreign taxes can be deducted on Schedule A as an itemized deduction, but typically they will not be, because there's an option to have a credit for foreign taxes typically. And a credit, you will get the dollar for dollar cash back on the credit. It's kind of like a payment as opposed to a deduction. So in other words, if we had a credit and a deduction of an even dollar amount, the credit would be worth by far more. And not saying that these two will be the even dollar amount per se between the credit and the deduction, but in any case, the credit typically will be more beneficial. So although we can deduct foreign taxes, in other words, as an itemized deduction, usually beneficial to choose to take the credit for the foreign taxes and therefore not take the itemized deduction for them. For more accounting information and accounting courses, visit our website at accountinginstruction.info.